So I'm John Jagerson, and as you heard from Jeff Gibby, I've been involved in basically investor education and investing for quite a while. I originally started trading currencies as the owner of an import-export firm. And the reason why I was trading currencies back then was that our contracts were denominated in foreign currencies. So as anyone who is living through this problem with the euro-US dollar right now can tell you, if you're accepting payment in US dollars, but you're having to pay expenses in Europe because that's where you're located, you've got a big problem. So the hedging risk in currencies is something that is done by people with business hedging needs all the time, and it works really well. We know that anything that is that works really well for hedgers is going to be pretty good for us as speculators as well. So specifically, my presentation is on hedging risk with currencies, not only in equities but across the markets. Now, of course, as any good trader should, I don't just look at hedging as an opportunity to remove some risk out of the market. When I say hedging, oftentimes what I'm really talking about is how can I smooth my equity curve? How can I increase my profits? What can I do to really make my trading a lot more effective? And currencies is something that is, I think, by far underutilized. I'm going to move forward one slide here. And, just one too many. Okay, so let me give you a little bit of background if you are not already intimately familiar with the currency market, since I know this was something of an introductory webinar. And I won't spend too much time on the basics. If you need a little bit more basic information, send me an email and I'd be happy to help you out. So a little bit of background. Currencies are traded in pairs, and there are a lot of pairs. And what you're really doing is you're playing the strength of one currency against another. So for example, the first currency here that I have listed is the euro-US dollar. And this is something that's been in the news a lot lately. So the euro-US dollar is over $1.40 per euro. So that's actually been quite a big rise. And as the value of the euro-US dollar has risen, what's essentially happening is that the euro is strengthening versus the dollar. So as the euro gets stronger and stronger, or alternatively, which I think in my opinion is more the case, or as the US dollar gets weaker and weaker, that particular currency pair is going to trend. So it's going to, and this is where speculators come in, where we can come in and start buying currency pairs or selling currency pairs based on what we think is going to happen. Now, I don't like to spend a ton of time on PowerPoints, so I hope you don't mind, but I'm going to be moving into the live charts here very quickly. But before I do, let me just do a couple of introductions. Number one, I'm going to be talking about the spot market. Now, when you talk about trading currencies, there are a couple of primary ways, and really only two big ways that individual investors can invest in currencies or trade currencies, and that's through the spot market or through the futures market. So there are currency futures that are available. Now, I prefer the spot market, and there are a couple of reasons for this. Now, number one is that currency futures, they're exchange listed, they're traded, so for example, the biggest currency futures exchange is at the Merc in Chicago, and they have a fairly small selection of currencies available that are traded liquidly. So there are only so many available. There are fees, so you pay commissions to be able to get in and out of them. They don't have fixed spreads, which can be good and bad, but I think it can be good in most cases. The biggest disadvantage actually that I find in futures is that they are fixed lot sizes. So what that means is that, for example, if you're trading the euro-US dollar futures contract, you're trading $125,000 worth of money. essentially. And they do have a mini contract listed that's half of that, but essentially you're at about $125,000. So in the spot market, what you're dealing with is it's an over-the-counter market. You're working with a dealer, and it's called the spot market because it's essentially not really a futures contract. It's a spot contract, meaning that you're not dealing with any time value or cost of carry or anything like that. You have the spot contracts are priced at what the underlying exchange rate is. So it makes it a little bit more simple. They're extremely liquid. If you're working with a big dealer, you're not going to have a lot of problems as far as liquidity goes. They're unbelievably liquid. The spreads are very fixed. You have a wide selection of currency pairs to choose from in most cases, depending on what you favor versus another. And there are additional things that they'll do for you. So it depends on the individual spot dealer, but almost all of them will offer contracts that vary in size. Now, I recognize that a lot of us are perfectly happy to take on big risk, whether it's $500,000 worth of underlying or $1 million worth of underlying, but and others of us are much smaller, and we may want to only take on $10,000 of underlying. So dealing with very small mini accounts, or even smaller than that, it's definitely possible, and that's where we get into this lot size thing, where you can even get, there are even some dealers that will allow you to adjust your currency contract in by multiples of $10. So you can get your risk adjusted to be exactly what you would like it to be. Finally, number 4, one of the big things that I really like about the currency market is analysis. I find is fairly straightforward. And maybe it's just that I find economic analysis very appealing, but that's largely what moves currency values, are these big macro things. So there generally aren't these the same kind of issues with a CEO going to jail, or that's an extreme example, but something like that might affect an individual stock. Currencies are largely immune to that sort of thing, and so really what moves currencies are big things, a change in interest rates, the credit crisis that we've been experiencing the last half of this year. These are the kinds of things that affect currencies. And, of course, technicals, which I know that we're all technical analysts, and currencies it's very easy to use technical analysis with currencies, just the same as you would in the stock market or trading indexes or whatever it is. So it is a 24-hour market, basically 5 days a week. So it's not accurate to say it's 7 by 24, although there is some price movement that will happen on the weekends, so Saturday and Sunday, that when the dealers are essentially closed. It's so minor, it's almost nothing. And one of the great things from a retail perspective, so from my perspective and your perspective, there's a lot of competition out there amongst the dealers, because it's one of the few markets out there that's growing as far as new accounts in double digits every year. So you've got spot dealers are competing on spread widths, and interest payments are two of the big things that I see them competing on, and they'll also compete on functionality and speed of execution and customer service, etc. But the big thing here is that spread widths and interest payments are something that will affect you specifically. And I actually have a couple of specific strategies that I wanted to share with all of you this morning that I thought might be helpful. And one of these relies on interest payments. So I know a number of you are very familiar with the ideas behind the carry trade. And that is, so that's one place where interest rates make a big difference. Finally, the last thing, I would say that the couple of unique benefits to the Forex market is that it's so liquid that stops and limits are conditionally guaranteed. Now, whenever I say the stops and limits are guaranteed, people always give me a hard time about that, because everybody's heard the legends of slipped stops and things like that. And for all of us who are used to trading in the stock market and futures market, well, we know that stops get slipped all the time. It's not uncommon for your stop not to get hit, or or for your limit not to get hit, or whatever it is if the market gaps up above it. That almost never happens in the Forex. I can say personally, I've been trading in the Forex for many years, and I have never had a stop or a limit get missed. Now, I'm more of a longer-term trader, so I know that some of the really, really short-term traders who are trying to trade right in the middle of the labor announcement, which, by the way, happens tomorrow, for those of you who would like to see a lot of action in the Forex, turn on your charting station tomorrow morning when labor comes out. That's generally a big time. But because I don't trade very short-term, I've never had a stop or a limit slip. So while it can happen, it's virtually guaranteed. Okay, so I'm going to, here's my objectives for today. The number one is I want to talk about how do we use currencies to eliminate or reduce some of our systemic risk, and even to a large extent our unsystematic risk. So, and here's what I mean by that. The risk is really, you can look at it in two ways. There's the risk in general of a whole market crashing. And then there's the individual risk relative to, let's say, an individual stock. Well, if you're someone who looks at the whole capital markets, you have similar types of exposure in that one market could just break away on you. And spreading your risk across additional capital markets helps to eliminate some of that risk so that you're not as exposed. And that's one of the big advantages with currencies, is that they are reasonably uncorrelated. So to necessarily your other financial markets, and so you can both use that uncorrelation to your advantage, and then where it is correlated to other financial markets, you can definitely use that to your advantage. I'm going to show you a couple of examples here in just a second. So obviously the number two objective is so I'm going to show you a couple of trading strategies that I use, and then I'm going to show you a more longer term strategy that I use and I'm a big advocate of. The big advantage here, that what I've experienced in the market, is that it smooths my equity curve, so it makes it a lot less choppy because I'm spreading out my risk. And then finally, number three, we're going to be looking at some very specific items that I think that you'll be able to execute today. So, like I mentioned, I like to get in the live market as much as possible, and so there are, as I was preparing this, I noticed over the last day that there were actually some of the opportunities that I normally look for are popping up today. So it'll be interesting to see how this plays out following our presentation. So I thought I would give you a couple of for instances here. The charts that I'm showing you right now, this is the dollar-yen on the left, and we have the SPX on the right. And now, here's the reason why I'm showing this, is that, and you'll notice that they're not perfectly correlated, but they do have a very similar shape. So they hit lows at very close to the same time. They hit highs at very close to the same time. But you'll notice that, so that they're correlated somewhat. The idea is, of course, if we can diversify some of our risk, we can spread it out into the currency market. We could use the yen, so the dollar-yen is the currency pair that we could use to hedge some of the risk in the in the stock market. So if we go forward one more slide here, we can use this is one that I use all the time, and in fact have a couple of examples to show you here in just a minute of the dollar CAD. So this is the dollar versus the Canadian dollar. These charts are daily charts. So this is the dollar versus the Canadian dollar, and then on the right I have crude oil. So you'll notice that if you look at these closely, you'll see, oh, they're almost flipped upside down from each other. They're very similar, but they're doing exactly the opposite thing. Well, that's because the value of the Canadian dollar essentially rises and falls to a large extent with oil. Now, you may be thinking, well, how is that diversifying? If I spread out some of my risk into the Canadian dollar and I'm an oil trader, what does that do for me? Well, it's actually extremely helpful because, especially as a technician, we can look for trading signals, opportunities that may be very clear on the Canadian dollar that are not so clear in crude, and they also don't follow each other perfectly every day. So by using them together, you have an opportunity to hedge out a little of the erraticness in the market and still make profits as an oil or stock trader I have one more example to show you, and then we'll jump into the charts. Okay, so this is the euro versus the TNX. So in this case, what we're looking at is 10-year yields on the right and the euro US dollar on the left. And the reason why I brought up the euro US dollar is that it's a great proxy. It's really it's the currency pair that you look at when you're trying to evaluate just what's the underlying value of the dollar. And even when you're looking at like the dollar index, for example, which is a futures contract traded in New York, there, even when you're comparing it to like the dollar index future, so the U.S. dollar, you'll notice that the basket of currencies that it's weighted against is overwhelmingly the euro. So it will, as the euro hits all new highs, the dollar overall is hitting all new lows. Now, the advantage here is that by looking at the TNX, we can take a look at what's going on with yields, because yields are definitely going to affect the stock market. So as yields are rising or falling, we can expect the stock market to kind of trail along with it. And we can offset a lot of that risk that we may start seeing erratic movement in the yield market. We can set off a lot of that risk by investing in the euro and trading the euro in addition to what we're doing in the stock market, or if you're trading the TNX, or if you're trading bonds, whatever it is. So I'm gonna pause here. We're gonna go into the live charts, and we're gonna go into the live charts, and we'll take a look at some very specific examples. Okay, so I'm going to share this. Okay, so now what I have here today, I just thought it would be really useful to make things as real as possible as to what's going on in the market today. And what's available in currencies, because it's a great place to be. So this is a classic chart. This is the euro US dollar, which means that essentially a great way to look at this is that if the euro is strengthening, it's going to tilt this chart so that it's uptrending, that's what's happening here. So, or if the dollar is weakening and getting lighter, it's going to float up to the top. Now, what I did was we hit kind of a bottom of a correction from this double top that occurred in July and August on the euro. We hit the bottom of that correction, about the middle of August. And then recently we've had a pretty decent correction as traders have been positioning themselves this week for, we had monetary policy come out from the European Central Bank and the Bank of England today, and then we've got U.S. labor, which is generally the biggest announcement of the month, that comes out tomorrow. So we had a lot of traders who were kind of saying, this is pretty rare air up here. Maybe we should pull back from the market a little bit. And so sure enough, they drove the value of the dollar up, which is going to drive this particular currency pair down. Now, when that began to happen, we got our first significant retracement of this previous trend. I applied Fibonacci analysis to it. This is really basic stuff, from the bottom to the top. And sure enough, I said, well, if we hit the 23.6% mark, so yesterday I'm making this analysis, if we hit that mark and we bounce up off of it, I'm going long again. So I'm long, and the profits here are offsetting some of the risks that I may experience in the stock market, for example. We all know the stock market's been really crazy. It's been very difficult for me to try to understand what's going on in the stock market and to make money there consistently over the last few weeks. You can see exactly the opposite situation here on the euro US dollar. So very convenient way to just diversify out your trades, even if you're not using diversification on a long-term basis, but to diversify out your trades. It's a great way to look for some new opportunities. So I mentioned I'm going to open a new layout here, and specifically what we're going to look at is the Canadian dollar versus oil. We'll wait for, so what's loading here on the right-hand side is the continuous contract for crude oil, which suits our purposes just fine. I don't have to look at a specific month. And we're going to look at a couple of examples and then compare to see, we're going to be able to compare and see, well, okay, so what was happening on the dollar CAD on a specific day? which in Forex terms everybody calls it the loonie because they have the loon on their dollar coin, and versus what was going on with Canadian oil at the time. So I'm sorry, with I'm reading my chart labels here. What was going on with crude oil? And was there an opportunity here to either offset some risk, identify a trading opportunity, or potentially find a reason to get out of a market? So my crude oil contract is being delayed here. Let me see if I can refresh it. Oh, no, there it goes. Oh, shoot. Boy, the nick of time has saved me from refreshing my charts. Okay, so let's take a look at a couple of days here that I think you'll find very interesting. And you'll notice that the market in the Canadian dollar was forming this really juicy bear flag here for quite a while, in July, August, part of September. We got a really nice breakout on September 11th, so not very long ago, last month. And I mean, a very clean break below our support, where we might have drawn our support levels, and where in fact most of us were drawing our support levels, with a big day, as you can see there where my cursor is. Now, what this tells me is that at the same time, if we go over here into oil, and I'm pointing right at September 11th again. We're mid-trend. Well, we know that now. But at the time, we were just at the end of a very long series of continuous green candles. How confident are we at this point that one, that it's a new opportunity to enter a trade, or two, that the trend isn't at an end? So, but we're much more confident when we look over here at the Canadian dollar. So we know that there was a nice clean, from a technician's perspective, this is a golden opportunity. Very ambiguous over here on oil. So the advantage here is that it clarified things. If I'm an oil trader, I'm still long. Conversely, if I'm an oil trader and I'm not long yet, maybe I'm getting in. Finally, the last way we can use this information is that if I'm an oil trader and I am long, I can use the dollar CAD to offset some of my risk. So I could short the dollar CAD or even go long, and that would completely offset my risk. Well, it would very effectively reduce some of my risk if I was feeling a little bit nervous but didn't want to get out of the market, out of the oil market. Second thing, what do we know about higher oil prices in the stock market? And now I know all of us should say, well, higher oil prices will make equity prices suffer a little bit, and we all know that lately that hasn't been true. But it's not uncommon, and in fact is a major risk that we're facing here for the rest of 2007 and into 2008, is that higher oil prices with a weak economy in the U.S. spell disaster for the U.S. stock market. Well, what can I do to offset some of that risk? I can short the dollar CAD. So it's a way for me to get into a very liquid market with extremely low barriers to entry, and to take advantage of rising oil prices, which will drive the dollar CAD down. I make more profits. At the same time, if I'm a long stock trader and I'm getting beat up a little bit in the market, I'm offsetting a lot of my positions. Let's look at another example, and actually I think this one is very interesting. We'll look at a current example. So I'm looking at oil again here, and you'll notice, so you can see what I'm doing. We got two tops here. So we got this great double top. Everybody's talking about this. I know every trader I know who's looking at oil is talking about this double top, and we've had a couple of really big down days, and the market is just beginning to come up to that support level. Here's what will happen a lot. One of these two markets will lead the other one. So we've had 4 days that, if you put the last 4 days combined together, and I know we're having a little bounce up today, and it's not shown on this chart, but if we put the last 4 days here together, we've had quite a decline in oil prices. Conversely, if you look at the dollar CAD, we haven't really had the same kind of reaction. So a short-term trader would look at this as an opportunity to basically capitalize on the lag in one market versus the other. Because this relationship is not efficient, we have the opportunity to take a lot more advantage of it than a market that's really efficient or a market relationship that's really efficient. So one of the things that I look for is an opportunity to go long or short a currency pair when before I might have normally had that signal triggered. Okay, so I'm going to close this layout. And we're gonna move to another interesting one that actually applies specifically to the stock market. So I'm going to be looking at, and I mentioned okay, so I mentioned that if we're if we're trading in all the markets, I've mentioned that you can not only identify opportunities by using some of this cross-market information, particularly in the currency market, but we can hedge some of that risk. Well, here's an interesting relationship. Over here, this is, of course, the SPX. So we're all familiar with what's going on here on the SPX. And over here on the left, we've got the dollar-yen. They will tend to follow each other, and there are a number of reasons for this. But the yen tends to weaken when stocks are going up, and it tends to strengthen when stocks are falling. So I won't bore you with the details behind the reason why that relationship works that way, but here's an interesting point of view. So I'm going to, I've applied a CCI to both of these. I don't know how many of you use the CCI in your trading. I do. I really like it. I like oscillators in general. And my favorite oscillator signal is a divergence. So you'll notice that here very recently we had a pretty solid divergence on the dollar yen. So what are we expecting? Well, it's a bullish divergence, so we're expecting the market to rise. And we can apply that in two ways, because here was the opportunity. At the time that this particular signal was forming, we were concerned about the yen itself, in that there was risk in China, and the credit crisis was really wreaking havoc on the yen. So it was looking a little bit risky. Well, during this period of time, so by the time we got this breakout, it happened about the middle of the month last month on the 14th. So and I'm defining this breakout simply as coming up to the zero line on the CCI. Well, by the 14th in equities, that was pre-breakout. So we were still staring at this head and shoulders formation. So we had this little shoulder here, head here, shoulder, shoulder. We were right at that level. At the same time, we were getting this nice breakout on the yen. Gave us a trading opportunity, and in this case, it worked out with the best kind of drama you can get when you're looking at these kinds of examples. With 2 days later, the market took off. That really big day we all remember on the 18th of September. So got a big move that was really triggered when at the same time we were having very ambiguous signals. We had this little head and shoulders pattern, but we really didn't have any clear indications, no divergence here on the CCI applied to the SPX, where we might have been expecting, or where we might have been looking for some confirmation, and we got that confirmation independently in the intermarket relationship. Okay, I'm going to show you one more of these, and then we're going to look at this very specific way to both hedge some of the risk that you've got in one market, as well as find opportunities between two markets. So I'm going to, well, first I'm going to close this. I'm going to open another layout here, and in this case I'm going to shift a little bit from we were talking about in the presentation, we were talking about the TNX, or the yields, versus the euro dollar. That's an important relationship, certainly. But here's a great one, and this one is so logical and obvious. So here's one, yields, the TNX in the US, so the 10-year yield index anyway, versus the dollar franc. Now, these tend to be very correlated, and which is great, because there's lots. It presents lots of trading opportunities. So here's one very specific, and although I'm using past examples, obviously these are applicable today. I mean, this is definitely something that you can use today. So let me what I'm going to do is we're going to start our analysis by looking at the TNX, or the 10-year yield index. And you'll notice, now, one of the things, every technician's got their own little pet strategy, right, or their pet indicator that they really love. I'm a gaps guy. I really like to watch for gaps and take advantage of the kinds of formations that you see developing around those. The one disadvantage for a technician like myself in the currency market is that because it's a 24-hour market and it's so liquid, there really aren't gaps. So they don't appear on your charts like they do in the other markets. Well, here, for example, we've got a let's see. So we've got a nice gap that opens up on the TNX, the 10-year yield index. And I'm sure a lot of you have heard the expression of a dead cat bounce. If you don't trade that particular strategy, it's one of my favorites. I love to trade it. But the idea is the market gaps down, hits a bottom, and then comes back up to that same resistance level, either the top or the bottom of that previous gap. And this is the bounce. So boing, and then meow, it begins heading back down again. That's the breakout that we look for. Well, what's great about this is that when this was happening, so by the time we got the bounce back down, it was about the 14th. As you can see on my charts, down there at the bottom, it was the 14th of August, and we got this nice breakdown. Well, you look over here on the dollar franc, and we'll find the 14th. Because here's exactly what we would be anticipating to happen on the franc, is that we would think that, well, such a clear and classic signal on the TNX should be headed right down. So what's going on the franc? We were just coming up to the first of this series of, well, the second of the series of three tops here. So we got this signal where there was a clear indication that yields were going to drop. And at the same time, we're getting in at almost the best time possible to take advantage of that drop on the dollar franc. Again, being able to use that information in a number of ways, either triggering a trade on the franc, which is great because trading in the Forex is awesome for day traders. The leverage is insane. You can get 100 to 1 leverage, which means that you could be trading a $100,000 underlying contract or value of the contract for $1,000 of margin. Which can be a lot of fun if you're a day trader. Very dangerous, but a lot of fun. So we could have taken advantage of it in that way. Because, in my world, retail traders, there aren't a lot of retail traders that know how to effectively take advantage of a drop in yields in the 10-year yield index. I mean, sure, there's options available on it, but unless you're a bond trader or something like that. So it kind of implies a certain level of sophistication, capital balance, etc. So oftentimes these great indexes are ignored because a retail trader may not have a way to trade it. Well, here's a great way to trade it, and it would have gotten us in plenty early. I have a couple of other examples here, but I'll spare you because we're running out of time. But and there's some good stuff I want to show you. But you'll notice something big here. Right now, here's what I'm doing. So we've got yields that have been dropping at the same time that the dollar franc has been rising. So I was actually preparing this specific example yesterday. And as I was looking at this, I was thinking, wow, that looks like a real opportunity because yields dropping, the dollar franc rising, that's not normal. It doesn't work that way. And now I'm making absolute statements when in fact we know in the market nothing's absolute, but nonetheless, that's triggering an opportunity to me. So what am I doing? I'm shorting the dollar CAD. And so today, of course, it's working out quite nicely. But this kind of an opportunity on an intermediate basis, so maybe a swing trade type time frame, works out really well, as you just saw with that dead cat bounce that we talked about, and even the one that we've got right now, where it feels like there's some energy being coiled up here in the dollar franc that's going to try to catch up with its little partner here, its sister market, the 10-year yield index. So let's watch that over the next couple of days. I think it'd be a fun opportunity to see how something works. Now, I'm going to shift gears here just a little bit. I'm going to close this particular layout and I'm going to open another chart, dollar, EUR, USD. Okay, so I'm back looking at the dollar, the euro dollar, and I just try to keep this real simple, just looking at a candlestick chart. And now we all are Metastock users because number one, they're the best charts out there in the market, but number two, one of the big reasons why I use Metastock is because I can test strategies. So if I have a good idea and I want to be able to apply that, so here's a challenge to all of you. Try some of those intermarket relationships. So use a signal that is telling you to do something in one market. So for example, oil, and apply it as a system to the dollar CAD. You'll get very, very interesting results because it's not uncommon for you to be able to preempt the actual move on the dollar CAD. So the Canadian dollar, the loonie. And it gives you a little bit of an advantage in some of those systems. So there's a challenge for you, but I'm just going to do a real basic one here. So we're going to pull up the Enhanced System Tester. And I'm going to apply one of the pre-built systems. They're fine. In fact, I find a lot of them really quite good. So and one of my favorites here, I'm gonna use an oscillator. So I'm gonna apply the MACD expert system. So I've just selected that over here on the left. I'm gonna click New Simulation, and what I want to do is to make sure that I show you a couple of things that you're going to want to remember as you're building systems. So I selected the MACD system, the MACD expert system, and I just clicked Add Securities, and I put in the spot symbol, which is $, EURUSD. So there's the cross, and I'm just going to test 250 periods, so we're not waiting forever for it to process. And then I'm going to go to Next. Now I'm going to leave this as a points only test because the way that currencies are priced is that because the currencies themselves, contrary to popular belief, are not that volatile when you look at them on a percentage basis. It's that their lot sizes are so big. Like for example, the euro dollar is carried out 4 decimal places, and that last decimal place. So for example, right now it's 41.26, and that last decimal place is that last decimal place. Any move up or down 1 digit there is worth $10 on a full size contract. So that's basically $1,000 margin. And 1 pip movement, so one of that 4th decimal place, if it moves up, you just made $10 if you were long the market. So and because of that, it's a little bit different than other. Most of us are really used to using the system testing for like stocks and things like that. And so here we have a couple of unique things I just want to let you know. The biggest thing. So I'm going to leave it as a points only test, and over here on the right hand side, I'm going to click More. And I'm going to leave this information on the first page the same. I'm not going to put commissions in here because you don't get charged commissions in the spot market for most dealers. And there's very few dealers that charge commissions. But the tab that says Trade Execution, I am going to change that. And I'm going to account for some slippage. So, and what I'm going to count, how much slippage I'm going to count for is basically 3 pips. So 0.000, and then there's a 3 over here. You just can't see it. And because that will account for the spread. And the reason why I'm that confident is that when you put in an order to buy or sell a currency, you get whatever price is displayed. I mean, it's just you just don't get any other slippage. The slippage you get is the spread. So 3 pips is a pretty wide spread. Most of your aggressive dealers who are really trying to compete are cutting that down to 1 or 2. So we're being extra conservative here. So we're going to press OK. And then I'm going to start our simulation. We're already done. We've got our results, and it's profitable. Surprise, surprise. And we had 15 trades over that 250 period test cycle. And we can go through all this information to try to see, well, so what happened? And basically, we were profitable to the tune of 1,130 pips. So not too bad. We can plot these results on the chart, which I just did. So you can see here I've got charted my 250 trades that would have been triggered, and I can start to understand this system and say, well, shoot, that actually looks really good. I may want to apply that in the currency market, and I can very effectively not only test it but find my signals in real time. So for example, as you can see here, trade number 15 along was executed way back here in the end of August, and was just the executed trade to get out of this was actually yesterday. So now we're waiting to see, well, all right, so we're going to get are we going to get trade number 16 lining up here? And it's the same type of technique and strategy that we would use in the in the stock market. Okay, I want to show you, we're going to shift gears a little bit away from trading and technicals and get into a little bit more of a longer term strategy that I think is one of the most effective ways to peel some risk out of your regular trading and enhance some of your returns. So I'm going to close this chart. And I'm going to close the euro. And I'm going to bring up another layout. And I think you'll find this probably as one of the most interesting things we do today. It's easily one of the things I'm most interested in the foreign exchange, and in really all the markets. Okay, so here's what I did. I just brought up 6 different currency pairs, and then I brought up an extra currency pair as an illustration, and then I've also brought up a stock, an ETF. I'm going to start by looking at this currency pair. Now, so far, what we've done is we've looked at how you can use essentially dollar-based or quoted pairs to take advantage of the what's going on in the currency market. But there are also crosses available where you can really take advantage of one currency. So, for example, what I'm looking at right now is a monthly chart of the pound yen. And we've been talking about this, by the way, for a long time, us currency traders, the pound yen. And what we're really taking advantage of is the fact that if you don't already know, by the way, since about the end of 2000, the Japanese interest rates have been virtually zero. So right now it's 0.5%, very, very low. And while in the UK, interest rates have been very high relative to the rest of the market since about the end of 2000. Well, and in fact, even before 2000. But this differential happened very quickly at the end of 2000, where essentially what that means is that it was very cheap to borrow yen, and what you were paid to own pounds was great. So what it created was this this interest rate differential, where one market was where the pound appreciated in value dramatically against the yen, and you can see that playing out here with this outrageous trend that went from the end of 2000 all the way up to currently. And we've had a little correction here, but nothing, in perspective of the trend, nothing that's too crazy. What's happening here is that when you're trading in the spot market, you get two things when you trade a currency pair like this. When you trade a currency pair where you're essentially taking advantage of an interest rate differential, you're relying on the propensity of the market to trend in the direction of that interest rate differential. Which will play out, by the way. Number two, you're also taking advantage of the fact that your Forex dealer will pay you for taking that risk. So they share that interest rate differential with you because you really are long one currency and short the other one when you combine those two pairs together. And there's a long explanation for that most of you probably know, so I'll spare you. But if you need more details to what I just said, send me an email. I'd be happy to fill you in. But here's what's happening is that when you hold the pound yen, your Forex dealer is going to pay you. And that payment differs, but it's generally every day that they'll pay you, and it's about a pip to a pip and a half, which means that you could be looking at a $15 payment per lot that you're trading. So on a $1,000 margin, you could be making $15 a day in interest payments, which means that not only were you taking advantage of the market's rise from 2000 through 2007, because the only analysis you did was trying to leverage that interest rate differential. So not only were you taking advantage of the profitability in the market, but you were also taking advantage of every day collecting a payment on your currency pairs, which is very exciting. And when you have a long-term strategy like that, segmented into part of your portfolio, it helps to smooth other things that are going on. So, for example, the stock market has a long-term propensity to move up. It was designed to do that. We know that it's going to do that. But we're active traders. It doesn't move up every year. So in one year that it's not moving up, there's a great way to diversify your strategies so that you've got another one that's making up some of the, or has a possibility of making up some of the difference there that you were hoping to get in the stock market. So I'm going to close the dollar yen because I think I've made my point. It's probably the most dramatic currency pair for it to illustrate the carry trade. Okay, so I'm just closing the pound yen, and I'm going to open this ETF that I brought up. Let's see. Oh, there it is. Okay, got a little lost. All right, so this is an ETF. And what it is essentially, it indexes a strategy where they took the G10 currencies. So that includes the pound, the Aussie, the New Zealand Kiwi, the yen, the franc, the Swedish kroner, the euro, on down the list. There's 10 of them, as the name would signify. And they say, all right, we're going to put this carry trade thing to the test. We're going to go long the 3 currencies that are paying the best interest rates, crossed with the dollar. And then we're going to short the 3 currencies that are paying the worst interest rates. So what that means is that all they've done is they just opened up, 6 contracts, and they've said, okay, we're going to go long high-yielding currencies, and we're going to go short low-yielding currencies. And we think that there's going to be that the market is not only going to go up because that's what it has a propensity to do, but we're going to collect the interest payment on both sides of those transactions. So we're going to get this nice little interest premium every day, and we're going to have the market has a good chance of going up. So that's what this particular chart, that's what this index looks at. Well, we got a bad tick in there, so just ignore the bad tick. But you'll notice that so over the last year we've had a nice uptrend. We had a little correction during the risk crisis, but I'm going to put that in a little bit of perspective here in just a second. Okay, so I'm going to close that. These other, well, in fact, I'm just going to close that chart because you get the point. Now, you could, if you thought that sounds like a good idea, one of the things that you could do is you could say, well, shoot, maybe I ought to just buy DBV. That's the symbol for that particular ETF because they're executing a pretty reasonable strategy, diversifies my risk. Well, I think that's a pretty good idea. Let me tell you why you don't want to do that, though. Right here, I have the 6 currency pairs that are in the G10 that represent the top 3 and the worst 3. So we got the top 3 here on the top, the Aussie, the pound, the Kiwi. Did you know that interest rates, the primary interest rate in New Zealand is 8.25%? Is that awesome or what? So you've got the top 3 yielding currencies up here at the top, the pound, the Aussie, and New Zealand. Didn't take a genius to figure that out. You can look it up online. And then on the bottom, I got the bottom 3. So I got the yen. Interest rates are at 0.5%. That's not good. The Swiss franc, it's much more respectable at about 2.75%. And then the Swedish kroner is even more respectable at 3.75%. So it's very reasonable. So we have the bottom 3 that so here's what we're doing. We're shorting, I'm sorry. We're actually long, just because the dollar switches places, and this is just a coincidence that it worked out like this. But in order to be long these 3 currencies up here and to be short these 3 currencies under here, because the dollar switches places in this little equation, the dollar comes first on these bottom 3, it was a coincidence, we would essentially be long all 6 of them. Now you're thinking, well, you got 3 that are going up and 3 that are going down. It kind of looks like it's offsetting. Not so. As you saw on the DBV when we brought that up, it's actually working out to be a very nice little uptrend. Let me give you a couple of stats on this, and you can test it yourself in Metastock. That's the beauty of having a software application like Metastock, is that you can you don't have to take my word for it. So throw this into Metastock and see how it actually played out. So here's the rules. Number 1, you have to be on top of your interest rates. Now, they don't change very often, so it's not that big of a deal. Get yourself an economic calendar for free, and you're set. So, for example, today I was watching interest rates in the UK. Are they going to pop? Are they going to cut rates? They didn't. So you always want to watch your interest rates to make sure that you have the top 3 and the bottom 3, and you're going to change it as the top 3 and the bottom 3 change. Number 2, in this particular strategy, the way that they are using it in the DBV is they use leverage of about 2 to 1, which for Forex traders, that sounds like blasphemy. They have 100 to 1 possible leverage. In fact, you can get up to 400 to 1 if you really wanted to be insane. So we have a lot of advantage. We can really leverage some of the opportunity here. So we could amp that leverage up 2.5%, 3%. In fact, I run it at about 2.5% myself. So 2.5% right there. And it just amps up my volatility a little bit, but it's okay with me because I outperform the index for sure. Over the last, since 1994, it's averaged about 15% per year, this particular strategy at a 2-to-1 basis, which is great. Now, that has been offset, though, by the fact that they manage their interest payment is managed inefficiently. So they don't do a very good job of collecting that interest payment every day. And if you're dealing in the spot market, because dealers compete on interest, it's a great way for us retail traders who want to take advantage of a long-term strategy that spot dealers really don't specialize in. We can take advantage of the dealer, the over-the-counter dealer, which is one of the, it's really hard to take advantage of a market maker, but there are opportunities to take advantage of an over-the-counter dealer because they have different relationships. So not only do we get to manage our interest rate payments more effectively, but we can manage our leverage more effectively, and because they only look at interest rate changes on a quarterly basis and we can adjust in real time, we can head off the start of a lot of corrections. So let me break this down into real terms. If you've been applying it with my modifications, plus add in the fact that you pay no management fees, if you've been monitoring the system, managing the system using some of my modifications yourself versus relying on a professional manager through an ETF, instead of 15%, and I recognize I'm amping up the leverage a little bit. Instead of 15% per year, you'd be looking at 27 to 28% per year. Bigger volatility, so my down years were worse, but over the long term, that's great, and a very effective way to basically take advantage of one of the underlying forces that drives the currency market, which is yields, against my investments and my investing strategies in the stock market, commodities market, bond market, whatever it is. And what I've effectively done is I've added one more tool into my basket of diversification to eliminate a lot of that systemic risk and unsystematic risk. So that's where I'm going to end the presentation today. We went about an hour, and this has been a real treat for me. I apologize for some of the technical problems, but for those of you who are still able to hear my voice, we will have the recording available very quickly, and I'm sure we'll be able to sort this out for the next presentation. But thank you, and I hope that what you will take away from this presentation is the action item that I would encourage you to take. Get your Forex feed, so get your spot feed, and put some of the techniques that I've told you about to the test. I'm telling you, it works it out. It makes it a lot more fun, a lot more variety, a lot more opportunity, and you've really broadened even if you decide not to trade in currencies at all, you're able to take signals and trading opportunities from currencies into the rest of the market. So have fun, and you're certainly welcome to email me if you have any questions. My email address is john@pfxglobal.com. I'm going to write that down here just so that everybody has it.